Hi, this is Gloria, the pink-haired investor realtor from Indianapolis, and we are going to start a new series. This is called Meet the Vendor, and today we have Jared Shore with Finance of America on with us, and we're going to talk a little bit about mortgages and what his company has to offer, and then just kind of what he thinks the market in Indianapolis is doing from the mortgage perspective. So,
Yeah.
Hi, Jared. Thanks. Welcome.
Hi. Thanks for having me on. I appreciate it. First one, huh?
Yeah, your first one. It's like it's
no
an
pressure.
Yeah, it's an idea the team's had, and it's just a matter of me getting them done and starting to roll them through. So
Love it. Love it. Well, I love the pink hair today. It's looking
thanks.
good.
Yeah, like put a little bit extra in this morning. It's a little bit brighter for camera.
Cool.
So Jared and I actually have been kind of bouncing off of each other for a few years now in the investor chat groups on Facebook and things like that. And we probably sat down, about a month ago now, and really just kind of started diving into his company and some of the unique things that he offers for investors. So I just kind of wanted to bring my investor audience into that conversation and just let us know how it's going.
Yeah, absolutely. I think that was several months ago now. Doesn't feel that long. Yeah, it's been there's been a lot of things happening between now and then. So and I think one of the unique things really that we offer, and just a quick background, I work for Finance of America, and Finance of America really does a lot of different things. We have mortgages, right? You're just kind of standard conventional run-of-the-mill mortgages that we do, and we do those. That's really probably the main focus of the company in and of itself, is just your standard primary residence type mortgages, and then we can do investment deals inside that. And then we also have Finance of America Commercial, which is really investor focused on the LLC side, as well as we also have some proprietary products that we've created that are really geared toward investors. So we really have kind of three avenues of business that we can do that, and I think what makes us unique and really the sandbox I get to work in is we get to use all three of those to our advantage to say, hey, here's a property we've got. What do we do, and where do we put this kind of in that sandbox? So I think that's probably the biggest thing that I have to offer, is just a whole lot of different stuff to fit what you're looking to get done.
Yeah. And that's kind of what I liked about Jared, is that, he's like, okay, just get your investors in here. And honestly, me, myself, because we've been talking, and Jared's like, just fill out the application. But basically, once you fill out an application, it kind of goes through a process, right? And you kind of look through, make sure their finances are all in order. And then once they start bidding on houses, then we can kind of, shuffle them into the avenue that they need to go. Yep. Is that correct?
Yeah. And I've got really two different sets of clients. The ones that I love, and I want to give them a hug when they bring me a property, because they've gone through the process and they've been pre-approved and they've gotten all their stuff, and it just makes everything so much easier. And then I've got the other set of clients I work with that my assistants and I just want to wring their neck, because they bring me a property and say, hey, guess what? We're under contract. And we're like, we don't even know anything about you yet. And we get them through the finish line, but it makes it just a little bit more of a stressful process. So the advice I would give you, if you're out there, is let's get you pre-approved now, so that when you do find a property, right, it just makes the whole thing just that much easier and quicker.
So education tip, even if you're just still shopping around, go ahead and go through the process. It doesn't hurt anything. It's sitting there, it's ready to go. And all of us know in this market, we've got to be aggressive, and we've got to be able to jump when we're ready to jump. So, have that started. Okay, so let's talk about traditional loans first. So again, from the investor standpoint, is it the traditional 20% down for single family, 25% for multifamily? And I'm thinking small multi, 1 to 4 units.
Yeah, sure. Like four and less is 2 to 4 units. Yeah, typically, now I should say, on single families, you can do 15% down payments. And in fact, one of the proprietary products we just launched is a 15% down payment without mortgage insurance. So, you take a slightly higher rate as a result, but, you eliminate your mortgage insurance. So you can go 15%. It really, again, it depends on what your goals are, right? Do you want to keep more cash in your pocket? Do you care more about cash flow per month? And those are things we're going to talk about up front to say, hey, where should we line up your down payment piece? But traditionally, yes, 20% is going to be the minimum. If you can get to 25%, great. Once you get to 2 to 4 units, it is going to, jump up to that 25% minimum down payment. So, pretty standard stuff there on the conventional side.
Anything they can do, or is it kind of a case by case on buying credits, that sort of thing?
Yeah, one, credit score is pretty big because your credit score is going to determine the cost of getting that rate, right? So yes, you would have options potentially, depending on where your credit score is, to potentially buy the rate down to get lower rates. And there's some unique things we can do inside of that. For example, let's say you're buying a single family and you want to put 25% down, right? One thing we can do, especially if it's a long-term hold, and a lot of people, I don't know if you've thought about this before, what about putting 23% down, right? And now you've got 2% extra that you can use to buy the rate down. So you didn't change your out-of-pocket at all, but now you're utilizing the same amount of cash to lower your interest rate, which long-term is going to be a lower payment. So you're going to save yourself cash flow and get yourself into a lower rate that way. So there's some unique things you can do to adjust and manipulate the rate.
Perfect. And sometimes that's the way investors just need to go, is just do nice, safe, traditional. Okay. So let's talk. I think you call it your loophole loan.
Yeah.
So is this kind of fitting the Burr method, or still for buy and hold, or what kind of investors do you like to take your loophole?
Yeah, so the loophole is going to be, I guess to understand why the loophole is there, you have to understand what we're trying to circumvent, right? So the loophole, traditionally, if you buy a property cash, right, you only have 2 options to recoup that cash. One is to do what's called delayed financing, and delayed financing is you're only recouping your purchase price, okay? You can't take out any additional cash if the value of the property is higher, where you got some equity to take cash out. So you can only recoup that purchase price, or you can wait 6 months to take out the 75% of the full appraised value. So the scenario there would be if you're getting a really good deal. You bought the property for $100,000, let's say, but it's really worth $150,000, right? If you wait 6 months, you can take out the full 75% of the $150,000. If you just want your $100,000 back that you purchased it for, you can do that right away with delayed financing. Okay, so the loophole is, how do I get that extra cash? How do I get that extra equity back inside of 6 months without having to wait 6 months? And so that strategy is you buy the property cash in your personal name. And really what you're doing is you're borrowing money from an LLC, right? Usually it's going to be your LLC. It could be, a partner's LLC, something like that. But you're borrowing that money. And that LLC then is putting a mortgage, you're recording a mortgage onto the property to your name. So you now owe a mortgage to the LLC. For us now, that's not a cash out loan anymore. It's a rate and term refinance. Okay. And we can do that inside 6 months. So the check at closing would be going to the LLC.
Okay. So
that's a very 30,000-foot overview of that process.
And I was going to say, I think Jared has explained this to me at least 6 times, and it's okay to keep this video, re-listen to him about 3 or 4 times, then give him a call and say, hey, can you explain that to me again? Because that's kind of about where I am. So just to put it out there for you. But I mean, it's a great option for certain investors that do that.
Well, and it's a great option where if you've got a really you're getting a good deal on a property, but it's going to take some rehab work out of your own pocket, and you get a really large value add to it, and it's a quick fix, right? It's a quick rehab where you did the rehab in 30 days. You got a renter in there, and now you're just twiddling your thumbs waiting for that 6 months. So we can get that done inside the 6 month period. Now, to preface that, it is only a conventional loan. That is not an LLC loan. It has to be purchased in your personal name, and you have to close the loan in your personal name as well.
Okay. All right. So then what about my Burr people that their projects might take a little bit longer? So they're purchasing it. They're going to put construction into it. It might take that 3 to 6 months. And then we're going to be at 75% of ARV. What product do you use for them?
So typically we're going to use a conventional loan, assuming they want to close it in, but it's just a standard refinance. If you're doing cash out on a conventional loan, it kind of goes, there are some restrictions once you get into multifamily. So 75% for a single family, you can go up to 70% cash out loans on multifamily 2 to 4 units. If we go to the LLC side, you can go to 75% on 1 to 4 units. So there's no limitation there. Now here's something that's cool, and we just launched these products, so I'm not 100% privy to all the little details in the guidelines. But we did just, one of the proprietary products we have is we can go to 80% rate and term refinances now for investment properties, which is pretty neat. So if you do have that lien on there, you can go up to 80%, and you can go up to a little bit higher debt to income ratios too, up to 50%.
Because I haven't been seeing those since COVID hit, basically.
Nope.
So almost 2 years, we have not been seeing that. So
Nope.
Give Jared a call about that. Get some more information on that. Okay, talk to me. Another product that Jared's got that I'm talking to him personally about is your line of credit product. So let's talk about that a little bit.
Yep. So the line of credit is really useful in a couple different capacities. For probably the most, I guess, popular way that people use it is for, if we're following the Burr method, for the buy and the rehab of your property. So it's a line of credit, and it's not a line of credit that most people think of like a HELOC where you can just go, use it as basically cash. It is a line of credit that you would submit property applications on to use on the line. So it's experience-based. So, I'll talk kind of on the brand new people first, and then it gets a little bit better. But basically, you're going to get at minimum